If you had to pick one mid-cap mutual fund for 2026 and you were not allowed to change it after you hit invest, which one would survive the pressure test? Because mid-cap don't fail slowly. They fail fast and they punish average selection. So in this video, we will shortlist exactly three mid-cap schemes, compare them like pro using risk plus return ratios, and then I'll tell you one I would choose as the best single mid-cap scheme setup for 2026. And yes, this is going to be numbers first, no vibes, no marketing, only evidence with data. If you like investing content that's actually data backed, tap like and subscribe in 1 second. Done. Now let's get to the real stuff. Here is the key rule for today. Returns alone don't win. In midcap, the winner is fund that give you number one strong long-term returns. Number two, with controlled volatility. Number three, clean risk adjusted performance. So our three finalists are HDFC Midcap, Nippon India Growth Midcap Fund, Kotak Midcap Fund. Most people compare 1 year returns. Smart investor know 1 year return are often noise, so we'll anchor on 3 year, 5 year, and 10 year, and then validate the quality of return using Sharp, beta, standard deviation, and turnover ratios. Let's start with the scoreboard. Returns first. As of late Feb 2026, HDFC Midcap about 23.35%, 1 year performance 27.61, 3 year 23.59, 5 year 21.14, 10 year. Now for Nippon Growth Midcap about 23.74, 1 year 28.18, 3 year 23.29, 5 year and 21.49, 10 years. Now for Kotak Midcap about 23.02 for 1 year, 23.46 for 3 year, 20.71 5 years, 21.26 10 year. So if you are thinking Nippon is highest on 3 year, correct. The best fund is not the highest return fund. It's the fund that delivered return with the best risk bill. So now we shift to the ratios. Number one, Sharp ratio, return earned per unit of total risk. In plain English, how efficiently did you get paid for the volatility? HDFC Midcap Sharp is 1.29, Nippon India Growth Midcap is 1.16, Kotak is 0.98. That's clear win for HDFC. And this matters because in midcap, volatility is not just discomfort. It creates bad investor behavior, panic exits, SIP stop, and re-entry mistake. Number two, standard deviation, the volatility meter. Lower is not always better, but lower volatility with strong returns is very powerful. HDFC midcap standard deviation is 13.88 percentage. Now Nippon, it's 15.42. For Kotak, it's 15.18. So HDFC again is the lowest volatility among the three. Now the ratio number three, beta, sensitivity to the market oblique benchmark. Midcap already swing, so a lower beta can reduce drawdown pain. HDFC beta is 0.86, Nippon is 0.95, Kotak is 0.89. Again, HDFC is the most defensive among the three. At this point, HDFC is winning quality, but smart investor will ask, what about cost? What about churn? What about concentration risk? Perfect, let's go there. Cost metrics, expense ratio for the direct plan. HDFC is 0.74, Nippon is 0.74%, and Kotak is 0.38%. Kotak is the cheapest by a lot. So why not just pick Kotak? Because cost is only an advantage when performance quality is comparable. In our data, Kotak 3 year return and Sharp ratio like both HDFC and Nippon. So Kotak becomes a low cost, decent option, but not the very best single pick if you are optimizing for the quality. Next metric, portfolio turnover. How frequently the funds churn or change the position or change the portfolio. Excessive churn can increase hidden friction and style drift. HDFC turnover is 18.22%, Nippon is 13.66%, Kotak is 24.31. All three are reasonable, but Nippon and HDFC are clearer than Kotak here. Now metric is concentration. How much is riding on the top of holding? That matters because mid-cap blows up usually come from one wrong big bet. Top 10 stock bet. HDFC is 33.28%, Nippon is 24.30%, Kotak is 29.45%. Now, Nippon is the most diversified by the top 10 concentration. So here's the real trade-off. Nippon, slightly higher 3-year return and lower concentration, but higher volatility and beta, and lower sharp than HDFC. HDFC, slightly lower 3-year return than Nippon, but base sharp, lower volatility, lowest beta, meaning the return quality is superior. Kotak, lowest expense ratio, but weaker 3-year and weaker sharp versus the top two. Now the final decision one scheme. If you want the best mid-cap scheme for 2026 as the single pick, my selection will be HDFC Mid-Cap Fund. Here's the reason in one line. It has delivered top-tier long-term return while showing the best risk-adjusted efficiency, highest sharp, lowest standard deviation, and lowest beta among these three. And that combination is exactly what smart money looks for, not just performance, but performance you can actually stay invested in. Because the real edge isn't finding a fund that goes up, it's finding a fund you won't abandon when it goes down. This is educational, not personal financial advice. If you want precision for your income goal and risk profile, talk to a SEBI registered advisor. If this breakdown saved your time and made the decision cleaner, like and subscribe. Short and simple. I'll do the same. Three fund, one winner format for small cap, flexi cap, and index portfolio next. Thank you very much. See you in the next video. Thank you.